All right, let's take a look at Amazon's latest quarterly results. There's a really interesting story here, but you do have to dig past the headline numbers to really understand what's going on with the business. We're going to unpack it all. First, just to set the stage, we have to appreciate the sheer scale of this company. Over the last 12 months, Amazon pulled in more than $716 billion in net sales. That's the baseline we're working with, the foundation for everything else.
Now, if we zoom in on the fourth quarter, you can see that momentum is strong. Net sales came in at $213 billion, which is a solid 14% jump from this time last year. The top line is definitely growing. The real question, though, is what's fueling that growth?
And when you break it down by segment, it becomes pretty clear. You've got very healthy 10% growth in the enormous North American business, and even better, 17% growth internationally. But the real standout, the part of the business that's changing the entire dynamic, is AWS. Yeah, it's the smallest by revenue, but it's growing at an incredible 24% clip, and its impact is way bigger than just sales. This is where the story shifts from revenue to actual profit. North America is doing well, a 9% operating margin. International is running on thin margins at 2%. But look at AWS. It is on another planet. We're talking about a 35% operating margin. In fact, AWS actually generated more profit than the entire North American retail segment on less than a third of the revenue. It's the economic heart of the company. So all of that flows up to the big headline number, $25 billion in total operating income for the quarter. That's up 18% year over year, a very strong number. But this is exactly where we need to start separating the real operational performance from some of the noise in the accounting.
And here is that noise. Hidden away in the filings are almost $2.5 billion in one-time charges. These were subtracted from the profit number, but they aren't part of the regular day-to-day business operations.
So what are they? Well, you've got a big tax and legal settlement, some severance costs tied to restructuring, and some asset write-downs. These are definitely real expenses, but they don't really tell you anything about the core, repeatable profitability of Amazon's business. So once you adjust for those one-off items, the picture gets a lot sharper. The core operating income wasn't really $25 billion, it was closer to $27.5 billion. This gives you a much better feel for the company's true earnings power in the quarter.
Okay, now let's pivot to what management focuses on. If you listen to their calls or read their shareholder letters, they repeat one phrase over and over. Their goal is to optimize long-term free cash flow. That is their North Star.
So keeping that goal in mind, this next number is pretty jarring. Free cash flow on a trailing 12-month basis has plummeted from over $38 billion down to just $11 billion. That's a 71% drop. It seems to completely contradict their stated strategy. But here's where it gets interesting. This collapse in free cash flow isn't because the business is failing, not at all. In fact, the cash generated from actual operations grew by a very healthy 20% over the same period. The business is gushing cash. And this table right here, this solves the entire puzzle. Look at the lines. Operating cash flow is up by almost $24 billion. But then look at the line right below it, purchases of property and equipment, or capital expenditures. That number has exploded by over $50 billion. And there you have it. That's the whole story. Let's be very clear. This is not a sign of a problem. It is a deliberate, strategic decision. Amazon is choosing to take the enormous cash flow its business generates and plow it right back into building more data centers, more warehouses, more infrastructure. The low free cash flow isn't some accident. It's the direct result of this massive reinvestment cycle. What we're really seeing here is a classic business trade-off. They are consciously giving up short-term free cash flow today to build a much wider, much more durable competitive advantage for the long term. Every single dollar they reinvest is another brick in that wall. So when you put all of these pieces together, the conclusion is unavoidable. It is a mistake to think of Amazon as a retailer. It's a self-funding flywheel. The high-margin profits from its cloud business are the fuel. That fuel is then reinvested into a capital-intensive global infrastructure. Each turn of that flywheel expands its universe of future opportunities, making the entire system more powerful.